If you're thinking about investing in the uranium junior market, you need to watch this video. Welcome to our viewers on cruxinvestor.com. And also, if you're new to Crux Investor, please click the button in the corner of the screen and subscribe to our YouTube channel. Today, we talk to Corey Dias, who's the CEO of Anfield Energy. They're a uranium player with assets in the US. We talked to him about his strategy. He believes they're an M&A company. They've got 35 assets, yes, 35. And they've got a 37-year-old mill, one of three operable mills in the US. We talk about his patriotic stance on 232. He believes it was and still is a security issue, and exactly what he's been spending his money on. We're also going to talk to him about the nuclear working committee that Donald Trump has set up to come up with an answer in the next 90 days, and also price discovery in the market. You can find these topics and more in the description below. Click on the relevant timestamp and it will take you to that part of the video. Right now, let's talk to Corey. Hey Corey, how are you?
I'm well, how are you?
Not bad, not bad. Thanks for taking the call. Look, we usually kick off the 1 minute summary, so if you don't mind, give us a 1 minute summary of Anfield Energy.
Sure. So Anfield is a company with the majority of its uranium assets in the United States. We have both ISR amenable assets and conventional hard rock assets. Our near-term focus is on the ISR space, and those are the assets that we hold in Wyoming. Mm-hmm. We recently closed a transaction whereby we acquired what's called the Charlie property. Yeah. The Charlie property is a near-term production opportunity for us. We have the opportunity to pair that with Uranium One's existing processing facility in Wyoming through a resin processing agreement we signed a couple of years ago. So our near-term focus is Wyoming and ISR. Our longer-term blue sky focus is the conventional assets that we have in Utah and Colorado.
Right. Okay. Perfect summary. So tell us a bit about you. What's your background? Why are you in the uranium space?
My background is actually in finance. I worked as a research analyst for a number of years for a couple of banks in Canada and some smaller firms. Had the opportunity to move to the other side of the market, on the dark side, as they'd say, to put my money where my mouth is, basically. Right. And the opportunity was given to me by one of our directors who was running another company at the time. I came in back in 2013 to take the reins of the company. We started off in copper. And then decided that uranium was a fantastic space to look at because it was unloved and really uncovered at the time. And we've been accumulating assets, from that point on, from both small companies and large companies. So we've been able to partner with some pretty significant players in the industry, including Uranium One, the fourth largest uranium producer in the world, and with Cotter Corporation, which is actually a subsidiary of General Atomics, a U.S. weapons defense manufacturer out of the U.S., which is a multi-billion-dollar organization.
Right. Okay. So why don't we kind of get some of the basic numbers out of the way? Give us the kind of the scale of what we're looking at here in terms of market cap, cash flows, all of that kind of gets, not cash flows, cash in the bank, etc. You wish, right?
As a junior, we're not quite in the cash flow sphere at this point. Market cap in Canadian dollars is roughly, we call it 13 or 14 million dollars. Our path to financials or financing is obviously through the equity markets, and we recently closed a $3.7 million financing. So.
Yes, so I saw that. You are a small company, but you've got quite a few assets, quite a few moving parts here. So give us sort of some sense of what the strategy, what the thinking is. What are you trying to build out here? Because obviously cash is going to be the restrictor in all of this. The quality of the assets, you've got to assess that, work out what you got, what you want to work on, what you perhaps want to park or flip. Yeah. So what's the thinking?
Sure. So, as I mentioned, we've got kind of a two-pronged strategy here. First of all, we have these ISR assets, which are primarily in Wyoming. So we've recently acquired the Charlie property, but we also acquired 24 other properties from Uranium One back in 2016. So the plan, and those 24 projects had a historical resource of about 30 million pounds. Right. So our aim here is to focus first on Charlie and then create a pipeline of projects to follow on from Charlie behind, this resin processing agreement we have with Uranium One in order to create kind of a long-term opportunity in Wyoming.
But do you know? Okay, so focus is Wyoming, great.
Yeah.
Charlie, new asset, fantastic. 24 assets. That's a lot of moving parts. Have you any sense of what you've got there? You know, outside of what the historic was. You know, have you spent money on it?
We've spent money. So what we focus on, we don't focus on exploration per se. We look for assets which have a historic resource, because all we have to do is go back and get an engineering firm to confirm what's there already. So
Right.
it's a lot cheaper to do that, to spend $25,000 to $50,000 on a report to confirm the historic resource, as opposed to going out and drilling and spending, hundreds of thousands of dollars to confirm.
And the math being, there's what was there. This is what's come out of the ground. There should be a number which is left behind. Is that simple as that?
Essentially, or if the historic resource is the resource that's there at the time, it just hasn't been confirmed through a third party.
Right.
So we get an engineering firm to come in, a third party to come in and say, yes, the resource that you've acquired is actually what is stated there. So it's not about what's been taken out of the ground yet. It's actually somebody's done the work already, but it just hasn't been recognized by a third party or by the TSX exchange, et cetera.
But at some point, you're going to have to spend the money to actually do a proper 43-101 or more. Is that right?
Right, and that's the $25,000 to $50,000, as opposed to getting a greenfield property where you have to go in and start drilling and spend hundreds of thousands of dollars in order to delineate a resource. The resource is there already. We're just confirming the resource. And so we've already, somebody else has done all the work of drilling. So
okay, seems a nice cheap way to kind of get to a number which is recognized. So that's 43-101 for all 24 assets, or
no, we do for each individual. So we've completed 3 already.
Right.
We've done one for Charlie. We're now working on a preliminary economic assessment for Charlie.
Right. So you could be at $1 million to do all of them. Is that right? If you did a simple report.
About $1 million. So it all depends. So some of the resources are much more easy to delineate or confirm than others. So we probably won't go through all 24. We'll probably look for the best 10 to 12, and then from those figure out which ones have the best economics in order to create that pipeline that would go behind Charlie. So if we can get another 10, perhaps 15 million pounds out of those 24 projects to sit behind Charlie's 4 million pounds, we have an agreement in place with Uranium One to process 500,000 pounds per year. Right. So that could get us anywhere from 20 to 30 plus years.
Okay. Interesting. Now, so get into Charlie. Tell us what precisely you bought. What have you got there?
Well, it's essentially a state lease, and the important idea behind Charlie is that it sits in between 2 of Uranium One's existing mines. So Uranium One is mined on either side, and this property is actually part of the same trend. So Uranium One had tried to acquire this asset and was unsuccessful, and actually had a conversation with us about the potential of picking up the asset. And so we spent 26 months trying to acquire this asset from Cotter and finally closed it this year. So the beautiful thing about this asset is that we've got all the infrastructure around because Uranium One's been right there. We understand the property because it's been mined on either side, so we know what's there, we know how to mine it. Right. And Uranium One's actually going to partner with us in order to facilitate production.
Right. And why couldn't they do that themselves? Why did they need you?
Well, this is very interesting when it comes to trying to get deals done. Sometimes a lot of the parties look at it as a zero-sum game. So, we have to win and you're going to lose in the transaction. Whereas from our perspective, we're talking about win-win. And we always ask, our first question is, what do you need? Or what would you like? Right. In order to get this deal done. And it's worked well for us. We've done it with Uranium One twice, and now we've done it with Cotter. So we seem to be doing something right. And I guess Uranium One recognize our ability to get deals done and ask us to pursue it. So.
Okay. And what's the split between you? How are you sharing that?
Well, we're not sharing. It's our asset. The good
there's
thing
a relationship.
Is that,
what have you engaged?
Well, they're going to help us. They're going to help us with wellfield development. Uranium One has all the skills, so they can. They'll get the ability to make money off of us through wellfield development, and they could potentially buy some of the pounds that we do end up creating at the site. Right.
Okay. So there's an agreement. There's agreement in place there.
There's an agreement in place for processing. So we have to pay Uranium One to process the material, so they're making money from the property.
Okay. I mean, talking of which, you've also got I don't know how to pronounce it. You've got a mill, Shooting Canyon?
Shootering.
Shooting Canyon.
Yes.
What's that?
So actually, it's one of only 3 licensed, permitted, and constructed
Yeah,
conventional uranium mines in the U.S.
Right.
So
Why is the word
word
conventional important in there? Why is that in there?
Because it's not an in situ recovery. So it's a different type of recovery method. It's like a traditional type of mill. So we can use for copper, silver, that type of. It's a hard rock underground, milling facility,
Right.
as opposed to processing for ISR. It's much more. You're basically shooting water into a well underground and sucking out the fluid, and then separating the fluid through drying.
Right. So that was built when?
That was built back in the early 1980s.
1980s, and it ran for how long?
Sorry?
How long did it run for?
It ran for 4 months.
Okay.
Yeah.
Talk me through that story.
It ran long enough to justify final payment on the construction of the property. Then the uranium prices fell.
Right.
And nothing happened there. The great thing about it only running for 4 months is that there's not a lot of environmental liabilities there. So it's the youngest mill of the 3 that are in existence in the U.S., and it has very little, if any, environmental liability. So it's very clean.
But it also hasn't run for a long time. Right. So
it hasn't run, but it's been staffed since it was built, because it has to be, because it is a uranium facility.
Yeah. So and what were those staff doing? Were they? I mean, you can't keep this thing in running order for 30 years.
They're turning knobs and greasing areas where it needs to be greased, and making sure that knobs turn, making sure that there's no seepage of anything, and it's an old facility, and some of the parts have been removed because they haven't been used, but certainly the building itself is still there. The conveyor belts need to be updated, but they're still there. The control room looks like something out of, Gene Roddenberry's Star Trek from back in the 1970s with the different colored lights, but it's still there, and everything turns on. So it's still, there's the ability to actually turn on lights, but you can't actually, there's no running plant. You can't, turn on and run things all the way through the facility.
Right. Yeah, it's like nearly 40 years old, right? So it's 35 years old or something like that. But how much money would need to be spent on it to actually bring it up to speed? To actually
you'd have to spend $25 to $30 million US.
That's 25 to 30 million bucks, which you don't have right now. And obviously the market being what it is, which we'll talk about in a minute, you ain't going to get that money anytime soon. So there's a point in the future where you've got the option of bringing this thing back on. How much did you pick it up for?
We bought that property. We bought a number of small mines and picked up some royalties for about $7.5 million.
Right. Okay.
Yeah.
7.5.
And Uranium One acquired the asset from a company called U.S. Energy for about $100 million.
Right. Okay. But back then, right? Well, when was that?
That was 2007, 2008.
Okay, interesting. So you've got all these various assets. So what's the big idea here? What do you? You're a finance guy. You're thinking of numbers. What are you putting together here, and why would investors kind of get excited about that vision that you have? Tell us about it.
Well, look, I think the important thing here is that ISR is the place where you want to be in a lower price environment when it comes to uranium. So we've established a complex there in Wyoming. So we have, properties that we bought. We have the Charlie asset, which is kind of a near-term production opportunity. We have a resin processing agreement in place in Wyoming, which means that we don't have to build our own facility, which is, a time killer and a cost killer. So we're saving both time and the cost of building our own facility in Wyoming in order to get to production. So there's a near-term opportunity there.
When you say near term, it's all kind of relevant again because of the market conditions. But so near term being you're as near as anyone else is. That's what you're saying, right? But right now we don't know when that is. Okay.
Right.
Okay.
Yeah. Oh well, look, I think of all the non-producers, we are closer to production than any of them.
Okay.
All the producers are obviously in production. They have facilities in place. They can produce whenever they like. But anyone who's a non-producer in the U.S., we are further ahead.
Yeah. Okay. Understood. Right. And the blue sky?
Blue sky, So part of the transaction that we completed with Cotter Corporation included what are called the Westlow properties.
Right.
So these are 9 mines that are in Colorado. Number of leases, the Department of Energy leases. We picked those up. They hold 11 million pounds of uranium and 53 million pounds of vanadium.
Okay, so you got the vanadium play here again.
That's right.
Tricky space, variable pricing, etc. But how do you work out the economics around vanadium? I mean, given the market, or have you done any work on that?
We've done a little bit of work. Obviously, we're very familiar with the battery sector. I actually, as an analyst, I used to cover clean tech, so I understand kind of the battery.
The RFB,
yeah. So I understand the renewable space quite well. So that's another opportunity. We can actually strap on a vanadium circuit to our mill in order to produce at our mill at some point in the future. So that gives us some optionality. There's also another mill, the only running conventional mill in the U.S., which has a vanadium circuit attached to it. There's an opportunity for us to potentially partner with someone to extract vanadium.
Have you any sense of what the vanadium price needs to be for you to be able to do that?
I think the vanadium price, I think it's around 7 or 8 right now, and probably in and around this range, perhaps $10 is probably where we'd like it to be in order for us to move forward on that.
Okay, but it's not core focus, but maybe at some point, if the price is right, you may be able to raise the capital to put that circuit in. Okay.
Absolutely. And I think, an important part too, so, the conventional mill that we have about 7 million pounds of resource that came along with it that can go through that mill. This acquisition of the Westlow properties actually allows us to create a longer life for the mill potentially, with 11 million pounds of uranium. So it's a 1 million pound per year facility. So we're talking about 18 years roughly of mill life.
Okay. So there's another 9 assets. You got 24. How many assets are you sitting on in total? What's that number?
About 34.
34. Okay, 34. And you're going through them all, trying to work out what's meaningful, commercial.
Yeah.
However you're defining that, and you're going to work out what to focus on because there's limited funds. I know you've just raised another 3.5 or so, 3.6 was it? 3.6 million.
3.7. Yeah.
3.7. Sorry. And you got to work out what to focus on. So what is the focus? What is the use of that? The 3.7 million bucks. What's that going on?
Sure. So I think that, as I mentioned, our focus is on the ISR property. So the hard rock, the things in Colorado, Utah, Shooter and Canyon Mill, those are all things which are not our near-term focus. Mm-hmm. So our focus is Wyoming, and our primary focus is Charlie. So all of our focus is going to be on Charlie and moving that forward.
Right.
And that'll be helped, through our partnership with Uranium One.
Totally. So how does that break down, though? I mean, is it literally all going on? You've got some G&A to cover. You've got a whole bunch of costs to cover. How much of it's actually going on the assets and discovery around those assets?
Well, yeah. So I guess there are a couple of things. So when we acquired the Westlow properties, there's some reclamation bonds associated with it. So we're using some of the funds that we've raised to cover off or to replace the existing reclamation bonds. So, we're probably looking at, $500,000, to focus, to use on Charlie in the near term. So that'll, including the preliminary economic assessment I mentioned.
Yeah.
Are some early, well field development work that needs to be done.
Yeah.
And probably a little bit of permitting and licensing. So, so that's kind of the near-term focus.
So that's $500,000. What's the other $3 million go on?
Most of that, there's some that's going to be G&A, and then there are about $2.5 million worth of reclamation bonds that are associated with the Westlow properties.
Oh wow! So $2.5 million on reclamation bonds. Wow. Okay, and that's something obviously you've got to do. You can't not do it, but you don't necessarily see $2.5 million worth of value. But if you didn't do it, there would be a problem. Is that the kind of issue with how you?
Right. Yes. A lot of the properties all have reclamation bonds, so the state forces you to put money up in order to cover the cost of reclaiming the land should you not move forward with the project or should something happen. They don't want to be responsible for taking a mine and returning it to fallow field. So they want the owners of the property or the lessees of the property to do that.
yes, I mean, it's pretty tough on a junior, isn't it? I appreciate, there's a lot of moving parts here, and everyone wants a slice of it. But you guys are. We talked about you're not cash flowing. You have to raise equity, expensive, dilutive equity every year. I mean, if I look at last year, right, $5.8 million in costs, right? So, but you're like $2.5 million on G&A, okay.
Yeah.
Stock-based compensation $1.9 million, that's a chunk of change, right? And then gain on the exchange rate. So that in terms of your junior miners available cash, you've got some big choices to make as to where you spend that, right? So
Absolutely.
On this 3.6, you're going to spend $500,000 developing Charlie. You've got the PEA you mentioned. Are you going to move that PEA to a PFS, or what's?
No, we're going to keep it a PEA. So the issue with creating a PFS or a feasibility study in the uranium space is that usually you have to tie it to a long-term contract. So in order for us, which is always a challenge to get a contract, especially current environment. So, our aim is you can go forward into production just using a PEA, and I think that's our plan.
Right. So let's come back to G&A, because I think and your strategy, because I imagine they're intertwined. So your strategy, you've got a lot of optionality, 35 different assets. Okay, you're working out what's there, what's good, what's not. And that's taking a lot of time, I guess, a lot of bought-in consultancy services. Is that 2.5? I mean, how does that break down? Is that a lot of bought-in costs around consultants to tell you what you have? Is that the problem?
Some of it is, but some of it is, like for example, the share-based compensation those are options.
Yeah,
right? They're not shares, so there's not, there's still a cash component that would have to come back into the company in order to get those shares.
Right.
We do have consultants in place because we have a very small team. Essentially, I'm here, and I have a part-time CFO.
Yeah.
So everybody else comes in as necessary. So when it comes to some projects, when we're trying to close on, for example, the Cotter Corporation transaction, we need external lawyers to come in to help us with putting together definitive agreements, and things like that. So there are some costs associated with it, but it doesn't, the times when it ramps up are usually the times when we are looking to close a significant transaction.
Right, because it's talking about, 1.7, nearly 1.8 of the 2.5 on the G&A was consulting fees paid by the company. So is that all around the M&A type stuff or the deals?
Yeah.
Is that that's what you're saying? Okay.
Yeah.
And
I mean, we are basically an M&A company.
Yeah, well, that's what I wanted to understand about your strategy. You are an M&A company. Are you an incubator? Are you saying we're never going to get into production here? It's the case I need to find out what's good, and then maybe someone comes along and partners, JVs, whatever. What type of company are you? When investors are looking at you, what are they buying into?
Well, look, I think there are a couple of things. I think our aim is to get into production. I think we've kind of gone a long way around trying to get to an asset that can get into production. We started off in 2015 buying the conventional assets from Uranium One.
Right.
The market at the time was actually much stronger than it is today. So I think everyone had the expectation that the market would continue to move north, and it didn't. So when we saw that the market was softening and realizing the differential between the cost of producing in an ISR environment versus a hard rock environment, we realized that it would take a very long time for us to get to the point where the hard rock assets are viable.
Right.
So that's when we started looking at ISR, because that's the only place where in a nearer term, you get the opportunity to get into production. So we picked up the assets from Uranium One to start moving forward in that direction. Obviously, there's still a cost associated with trying to get those assets in production. We started looking around to see if there's anything that's closer to production status than what we had in our portfolio.
Right.
And Uranium One facilitated that process by introducing us to Cotter and saying that, this would be a perfect asset given where it sits, given the cost to actually move material from this mine to the satellite plant and finally into the final processing plant, given its location, its proximity to our assets. So So we started off with hard rock, high cost, and we've moved the way down into ISR, near term production. So we've kind of gone backwards.
So, but you said at the beginning we're an M&A company, and I think that's what you are today. That's,
We are.
it is what you are today.
Absolutely. Look, we're in a low price environment, and there are assets for sale. In a high price environment, we probably wouldn't have been able to buy any of this.
Right. So people are buying into your ability to do deals or identify deals which potentially have value, and for you to very quickly and cheaply discount the ones which perhaps don't meet the required levels that you're seeking, and for you then to be able to develop those and get into production at some point. And you're with the mill, you're looking at being able to have an infrastructure to look at that whole chain, right?
Correct.
Okay, so I just wanted to understand what you were today. That's all. Okay. One thing which stood out for it, investor relations, $500,000 last year. What were you promoting? Because it's like that's a lot of investor relations.
It is.
What was going on?
A lot of assets. We have a lot to talk about.
Right.
We've got vanadium to talk about. We've got ISR. We've got hard rock. We've got a lot of different things that we can focus on, and depending on where the market is, we've put out news releases on vanadium. Because our Utah assets have vanadium in them. Now we've got Colorado, which has significant uranium. So, we've got different ways to kind of, skin the cat. So depending where the market is at the time, we will spend our time focusing on one area or another.
But if you're doing, so that's the thing. I'm intrigued with the junior company mentality. So, I'm looking to you for help here. Is you've not got a lot of cash. You've got a skill set. You're positioning. You're M&A. You told me you're M&A. You've got a lot of optionality, but you must know what's going to work, not what's not going to work. I mean, for instance, spending time in vanadium and the environment which vanadium sat at, certainly the last half of last year, that wasn't necessarily where I would have thought you should spend your time talking to people about. So, when you're doing investor relations, what does that involve? Are you traveling the world to have conversations with institutional investors, or what's it actually mean?
Yeah, look, we do spend a lot of time traveling and meeting with investors, because it's the interesting thing about uranium space is that it's more about education at this point. It's not a well-known space. A little bit of knowledge sometimes. It's a lot of the knowledge. When people have very little knowledge, it's usually pretty negative, or at least the perception is negative. So we're spending a lot of our time trying to overcome that negativity and really explain why is this space actually important? And, it's not all Chernobyl. It's actually, they're real viable businesses which have run for a long, long time. And, there's been no risk in terms of.
But that's not your job. Some big guys with some big pockets. We've spoken to a few recently. They got tens of millions in their back pocket. Isn't that their job? You don't need to do that, do you?
But it's their job. You still have to educate, because not everybody's going to be in the same, not everyone gets access to Cameco, right? So they need to understand from smaller companies. They can get a lot more information from us than they can get from Tim Ritzel over at Cameco. They don't have access to Tim Ritzel.
Right. Okay.
Right? You need to talk to others in the space to really get a better understanding, and really be able to dig into, what exactly are you trying to achieve here.
Okay. Well, let's finish off on in terms of the company bit. Where do you sit in the market? Where do you position yourself in the market when you're going and doing this world tour of leading institutions? Where are you positioning yourself, and why should new investors looking at you, watching this video today, why should they be looking at you versus the next guy?
Look, I think as I mentioned, we're probably the next company to get into production, assuming the uranium price moves in the direction that we all hope.
Right.
We've got an asset which has been coveted by not only us but other parties in the sector because of, first of all, its proximity to infrastructure, and the potential partnership with a significantly large producer in order to move that asset forward. So I think that is kind of key. The fact that we do have these relationships are very unique in the sector. Most of the juniors are kind of off on an island, but we've managed to build relationships to the point where we can collaborate not only on this asset but on other projects going forward. So I think that's very important. We have that path to production, which is near term. And look, that path to production has been validated by our conversations and meetings with utilities. Utilities are looking at us, especially before 232. Maybe the conversation might be a bit different now because 232 didn't quite go the way we'd hoped. But the conversations were very much about looking to secure pounds going forward from junior players, including us. And we were part of that package. So I think that's an important point too. We have a path to production that's been recognized by the ultimate buyers.
But don't the basic rules of mining still apply? You need to be able to mine, not just get into production. Just because it's uranium doesn't make it hallowed ground. It's the basic rules of mining apply. You've got to be able to mine commercially, yes, economically. The numbers need to stack up. Obviously, if I'm talking to someone in the Athabasca Basin, they're going to tell me they've got it made, whoever they are. The grades are high. Your grade's not so high. They're a lot lower. But you're looking, I guess, at the Uranium One guys and saying, well, there's a nice comp. They're either side of me. That gives me a sense of, for Charlie, where we sit. You're not there yet with your 24 assets plus 9 assets. You still got to work that out.
Sure.
Right? And right now, you're a finance guy running a company. Where's the technical team that's going to help you deliver this? Are they...
Well, if you look at my board, we have over 120 years of uranium experience. One of our board members actually did the feasibility study for Charlie, so is intimately familiar with the project. We have...
Who's that?
Steve Lunsford.
Okay. And you've also had... Oh, right. Yeah. So Steve, tell us about him.
So Steve Lunsford's he's a local Wyoming guy. He's been in the business for 40 years, worked for Cameco Resources, which had acquired Power Resources, which owned the asset in the past. So he is very familiar with Wyoming, familiar with ISR, intimately familiar with Charlie. So he's our go-to person.
Right. And John Eckersley, who has just joined, he's been advising you prior to that, though. Is that right?
He has been. So John has been he's an attorney.
Yeah.
He's worked with junior companies for a number of years and spent a lot of our time going through our contracts. Any kind of NDAs that we have to put together, things like that. He'll spend his time.
And does that inform us that there's going to be more M&A?
Well, you can you can interpret it that way. You could. I think that's probably a good way to look at it. Yes.
Okay. That's good. Now, let's talk about this last week. Okay.
Sure.
You ready? Have you got the energy to talk about this last week?
Yes.
Okay.
It's been a rough week. It's been a rough week. It's been a rough week for U.S. companies. Absolutely.
Okay.
Yes.
Now you're sitting with U.S. assets. You had a little hit as well, right?
We did.
And you used a phrase just now, 232 didn't go the way we hoped.
Correct.
Right. So I'm guessing which camp you're in.
Well, of course, we're in the producers camp. So.
Right. So, run us through that. Obviously, on the run up to 232, everyone's very, very excited about what Trump was going to do. Polarizing views, very, very passionate community, the uranium community and nuclear community. So your view was you hoped that there would be some kind of what? What were you hoping for? What was a good outcome for you?
Look, I think the outcome that, the producers were hoping for, at least the junior producers, was U.S.-based producers, was a quota. 25%. Compelling the U.S. utilities to buy 25% of its needs from U.S. producers.
But that wasn't ever realistic, was it? You can't go from 0 to 100 miles an hour that quickly.
Well,
so what would it have looked like?
It wouldn't have been 0 to 25. It would have been a staged, kind of step up to 25. So, because there's no way to produce 25% of its needs today.
No,
so it would take some time.
And so, were you buying the security argument, or which bit of the argument were you buying into, or do you think it was a conversation that needed to happen? Where were you sitting?
Well, look, I think it's clear that the national security risk is significant. You've got, Russia, Uzbekistan, Kazakhstan, controlling 40% of the market. And, we've seen what Russia's done in the past with natural gas over in Europe. you're turning off the spigot, there's a big risk. The U.S. is the largest consumer of uranium today, and imports over 95% of its needs. So, if there's any disruption to that supply, that's a significant risk to 25% of your power.
Right.
In the United States. So there is a national security risk. The same, it was looked at a number of years ago when it came to, oil. You had OPEC running and controlling everything, and there was a risk, in the U.S. that you wouldn't be able to receive the oil that you needed. So the market turned around and focused internally.
Sorry.
And now the U.S. is an oil exporter.
Sorry, remind me about your shareholding. What is there in terms of who are the major owners of the company?
Major owners?
Well, major shareholders. Sorry, yeah.
Yeah, so Cotter Corporation is a significant holder.
Yeah.
And that was part of the transaction we closed with Cotter. So they became a shareholder because we provided them with shares of our company.
Right.
As part of the compensation or consideration.
And they said on how much?
They'll hold about 11.5 million shares.
Right, okay. And who were the other biggies?
So the other one of note would be a company called Radio Fuels, which is a private uranium company with assets in Canada.
Right. Okay.
And this one wanted exposure to U.S. assets.
Okay.
And so participating in our last finance.
Okay, interesting.
So those are the two major ones.
Okay, fantastic. Sorry for that segue. So 232, you believe it and still believe it's a security issue. Trump disagrees. So we moved to a 90-day working group. What are your hopes for that?
Right. Just to clarify, Trump agrees with the national security risk. He doesn't really agree. He doesn't agree with the quota. So.
Okay. You didn't get what you wanted because he didn't. Yeah. Okay. But okay. Yeah. He agrees, but he doesn't agree. So what's the 90-day working group gonna do for you?
That's the big question. I don't.
What do you want them to do?
Well, I'd like them to put the quota in place, but that's not going to happen. So,
okay.
I think at this point, what's more likely is that there might be a potential of incentives being provided to the utilities to buy American. I don't know how significant those incentives would be, whether it's subsidies or something like that. Perhaps there might be monies available to uranium producers in order to facilitate production. Whether there are subsidies available to us, cheap money for us to move assets forward to production. There'll be small measures, but I don't see them being obviously nearly as significant as what a quota would have done for,
right.
For producers.
Right. So again, possibly we're in another period of uncertainty. Utilities aren't necessarily going to move forward until they know what's going on after this working group, and then there's a period of evaluation, right? So the uranium equities companies need to kind of get on, don't they? They're kind of reliant on the spot price. They're reliant on hopefully the contract market coming back online at some point, or some line of sight to when it's going to come back on.
Right.
But this 90-day working committee, working group is to look at the nuclear industry as a whole, the holistic view of it, and you've kind of got that's the reactors are owned by the utilities generally in the US. Is that right?
Yes, that's right.
Right, and so they're sitting there with their mix of presumably still coal, gas, renewable energy portfolios. Nuclear is just part of that mix. So I guess they're slightly conflicted in some sense. I mean they were arguing against the 232. That's
right.
So
it's they're arguing against it because of the potential increase in costs to the utilities when it came to uranium inputs.
Right.
But I think it's important to note that a lot of the utilities are working on contracts which are were signed a number of years ago at significantly higher prices than where we sit today. Contracts in the between the 50s and the 80s. $50 to $80 a pound. So an increase to $40 to $50 is not outside of what has been the usual practice in terms of what's being paid. So I think I think there's a little bit of kind of panic screaming, which was not entirely justified.
Right. Yeah, maybe. I mean, there's a lot of moving parts, and there's a lot of influencers, a lot of people with vested interests in this, obviously, and ultimately, utilities don't necessarily want to pass on the cost to their customers, or they don't want the customers to have to stomach the cost of subsidies at a local level. If it's a security issue, that's a federal issue, right? So there's a lot of arguments to be had here.
Sure.
I mean, but the bigger picture around nuclear is not just about the uranium equity play. It's there's the enrichment component. There's no enrichment facility in the US anymore. There's no there's a lot of things that need to be discussed. So therefore, are you worried that your bit of it is going to get sort of parked to one side and you're going to continue in this vacuum of uncertainty until all of this is resolved? Because it's a pretty big picture that needs to be, looked at.
It is, but I guess, you've got a 90-day window in which to look at it. So I'm not sure.
What are they going to do? What are they going to do in 90 days? Aren't they just going to say there's a lot of things we need to look at and we need to kind of create some more secondary working groups to look at each of those components? This thing could run on.
It could, but I think the reality of the market, I think what's going to happen now, because you've had this delay in purchasing, there is a deficit in the marketplace.
For sure.
When it comes to supply demand, as much as other parties would argue otherwise, it's clear that there is a supply demand. But I think once now the utilities start to re-engage and start to look at, whether they're doing contracting or they're going back to buying the spot market, they're going to realize that the pounds aren't there. So they will have to find a way to get those pounds. And those pounds will not be available at $25, unfortunately, in terms of a long-term contract. Whether it's Cameco, whether it's Kazatomprom, Kazatomprom has now put itself in an interesting position because for a long time it was a state company. It was not public. And now, its aim as a public company is to show high price contracts to its investors in order to show there'll be a profit motive going forward. So
it's an interesting thing, but it's a question of who's going to blink first, right? It's going to be who's going to be the first guy to go. Is it going to be from the supply side or the demand side? Because no one wants to go and have that chat with the boss and say, hey, spot price is at 20. Let's say $25 today, but I've got an opportunity to buy it at 50, but on a long-term. No one's going to do that, right? So
no, because utilities aren't incentivized that way. Utilities are incentivized on a quarterly basis. So you don't want to be the guy it's not whack-a-mole, right? You don't want to be the guy whose head is above at $50 when everybody else is at 25. You want to be in the lowest quartile. Your compensation is based on being in the lowest quartile. So
who's going to blink first?
Fit.
Who's blinking first?
It doesn't fit. Yeah.
It doesn't fit, but who's going to be the guy that says, what, I'll take this one for the team?
Well, that's a good question. I don't know who the first guy will be. I mean, I think that's the challenge. But there will be a first guy because Cameco is not coming back online at $25. Kazatomprom will have a difficult time convincing its investors that it's good sense to sign a contract at $25. So, the price will have to move in order for contracts to start being signed. So as much as the utilities are now, what is now done is basically turned into a global market. Now they would have been forced to buy US at $50 or $40, whatever the price would have been. But now it's going to be a global price at those terms, global market at those terms. So there won't be contracts signed in the near term, certainly not at $25. I think the price will probably be $40 plus in any case before a contract signed.
And I guess the issue is that there's no one, not even Kazatomprom, not Cameco, that can on their own fill that supply demand gap. It's vast.
They could fill it, but not at this price.
No.
So it's all price. Yeah. It's all price, right? Cameco does not make money at $25. Right. So Cameco has a number of long-term contracts in place, and probably in the 70s and the 60s, that's fulfilling now, but it's fulfilling those through purchases in the spot market, right? So even if the utilities want to go into the spot market, they're competing against Cameco. And Cameco is buying all the material that's going into the spot market. So there's been no spot market available for the utilities. So then the utilities have to turn to contracts, and then nobody's signing contracts at $25. So they're going to have to keep pushing that number up higher and higher and higher to get to the point where somebody on the supply side steps in and says, okay, we'll do it at $40 or at $50. So, $25, it can't stay here, and it won't stay here because there's no material available here.
Yeah, I mean, that's such a big discussion around the supply demand curves. You're a finance guy, ex-analyst like me. You've got to, the thing that interests me is, that there's got to be a point in that curve where you go, the big guys go, well, I say we're happy to keep the margins low enough at this, for this period of time, because that means we'll have no new entrants. A lot of these guys who are sitting on big assets won't be able to raise the cash. We can go and pick up some cheap cash, and we'll make hay further down the line because we'll own some of the better nearer production assets. So that there's that kind of thought in my head with regards to, do the big guys think like that? The geopolitics of it all, does it work like that? But I guess one for another day. One which is for today, and we'll finish off on this, is you're a small company, 14 million bucks Canadian. You just raised a bit of cash. We've spoken to a few new entrants into the marketplace, and there will be more. If the market goes the way you need it to and the way you want it to go, there will be new entrants into the marketplace. It's just, that's the way these things work. There'll be a lot of noise. You've got a little bit of a head start. Your nearest term production compared to the rest of the non-producers. But are you concerned about these new people coming into the marketplace and stealing your thunder? Are they going to be able?
Absolutely not.
No. Absolutely
not. No, I think, as I said, we've been able to pick up some pretty decent assets which have near-term opportunity. And our aim is not, we're just not here to promote. We're here to get into production. So, as I said, Charlie and a relationship with Uranium One, having something in place moves us further ahead of a number of players in the sector. I think the Shearing Canyon mill, there won't be another mill built anytime soon. And obviously the refurbishment cost seems, sounds significant, but when you put in the context of the cost to build a new mill and the time frame to build a new mill and getting over NIMBYism, not in my backyard, it's going to be a big challenge for anybody else to get a mill built. But I know that, I'm not sure if you're familiar that Western Uranium last year lost its license in Colorado. It had a licensed had an actual radioactive materials license, which the state pulled away. So it shows you how unique these things are and how tough it is to keep them. But the interesting thing about that one is that it wasn't tied to a facility. So to get a license on your own without a facility is going to be a challenge. So from our perspective, we're feeling very comfortable that we've got something of kind of unique value.
But aren't you going to have to do something quite big, because you haven't got enough money to get into production yet? You're going to have to go and raise some money, okay? The assets, you're not quite sure what you're going to be able to do with these assets yet. And when you are sure, you're going to have to go and raise a stack of money, okay? So today, the bulk of the value of your market cap or enterprise value, whichever one you're going to look at, is the mill. And the license for that mill, to operate that mill, presumably, so that no one's giving you value for the the assets that you've got on the books today, right? Because they're not worth a lot.
Well, I think the way that we're being valued is actually the ISR Wyoming assets are getting value. I don't think we're getting any value for the mill.
You don't think you are?
Any value for conventional assets at all.
Okay.
No, we don't think we are. We think that anybody who's investing in our story today is focused on Wyoming. They're like, oh, it's interesting. What does it cost to get into production, conventional production?
Right.
$60. Well, where are we today? 25. Where's the term price? 35.
Yeah.
Zero there. So I think everything is kind of, because everyone who's in production right now is actually in the ISR space. So The fact that we have assets in the ISR space is giving us some value.
But if
we didn't have those ISR properties, I don't think we have a market cap where we are today. I think it'd be significantly lower.
Well, it's kind of insignificant whether you're 13 million or 30 million. You're no nearer production, and the spot market's doing what it's doing, and until contract comes on board, you may as well be worth zero. It's the same net effect, right? But which is why it intrigues me about the mill intrigues me as a USP, as a differentiator for you. When things come good, you would expect to see a significant re-rate, not just because of the production or the potential economic assets, but because of what you can then do. So is that part of what you would argue to new people looking at you, that you've got a whole bunch of zero rated or zero valued assets, so therefore when the clock starts ticking, you're going to get more of an uplift than others? I mean how?
Absolutely.
Right.
Absolutely. I think it's a significant differentiator, because when the market does move in the direction that we all hope it does, we have an asset which is very unique in that sector, which we can turn on,
right,
to give us £1 million plus more production.
Okay.
And I think that's.
And then you need to come up with a solution of, where do I get the money? How do I keep dilution down? All of that good stuff, which finance guys go to bed thinking about. But look, Corey, I really enjoyed it. That's fantastic first run by on Anfield Energy. It's nice to hear the story about where you sit in the marketplace. You've clearly got a thought in your mind. You got a bunch of stuff to do. You got to
absolutely,
okay. And you've got a lot of assets to look at and work your way through. I hope the market is kind to you. Hope the uranium market sees a change sometime soon. It'll be interesting to sort of see how the utility guys react and what time frame they react in, because obviously you guys need that.
Absolutely. Well, thank you for your time. I appreciate you having us on.
Yeah.
And I love the questions. I think your questions are, they're relevant and insightful. So thanks again.
Thanks very much for watching. We hope you enjoyed that. And if you did, please click the button in the corner of the screen to subscribe to our YouTube channel. You can also catch us on our website, cruxinvestor.com, and Cruxcast, our podcast series. Plus, most days you can catch us on LinkedIn and Twitter. We'd love getting your feedback, so please keep that coming, and we'll speak to you again soon.